Hello in 2021 and welcome back to Sam's Finance, where I talk about personal finance, companies and their stocks. First of all, I am very pleased that my last video, the German broker comparison for 2021, was and is so well received. However, I also received some constructive criticism, namely that you should actually first consider the product in which you want to invest in and only then look for the right broker instead of doing it vice versa, what my broker comparison a little bit encouraged to. And in all honesty, I totally agree. From experience, however, I know that it is seldom the case that you keep the product, so the stocks or ETFs, exactly as you ideally planned to do in the beginning for long term. Over time, you learn a lot more things about investing, and then you often find out that, for example, another ETF would be more suitable, and then, of course, you change your ETF. So I think it makes perfect sense to use a broker that is as universally good as possible in order to not have to transfer the funds later. Because it is much easier to change the ETF than to transfer to another broker. And then this comment gave me the idea to make a quick video about how to fundamentally choose a financial product. And in this video, we are going to look at how to choose an ETF. A few quick basics about ETFs, so we are all on the same page. ETF stands for Exchange Traded Fund. From the name, you can already guess that ETFs are in many ways similar to mutual funds. An exchange traded fund is also a basket of securities. However, in ETF trades on an exchange just like a stock and not only trades once a day after the market closes as with mutual funds. Just like mutual funds, however, ETFs can contain all types of investments, including stocks, commodities like from gold to corn, or bonds. Most often, an ETF tracks an index like the American S&P 500, the German DAX, or the global MSCI World, for example. This simple index tracking makes the active fund manager redundant, and together with the easy exchange access and the resulting competition among ETF providers, that leads to very cheap fund fees compared to traditional mutual funds. Then moving on to the next point, you are also investing in a basket of securities and not in just one. And this automatically leads to diversification, what is beneficial for your risk management. And with this diversification, as the case with the S&P 500 ETF, for example, you cannot realistically suffer a dead loss, because that would mean all of America's biggest companies would go bankrupt overnight. And let's be honest, if this should happen one day, we have greater problems to deal with than managing our portfolios. The price of an ETF can most likely therefore not go to zero. The price of a single stock, however, can. So that's what I wanted to point out. This is what makes it perfect for beginners and for most people actually, who don't want to leave their assets to inflation, but who also don't have the time and the interest to deal with the capital market too much. If you choose a global ETF, then you can basically fire and forget your investment, what is really comfortable for many people. Especially during times like these in which credit interest hardly yields anything or even becomes negative, as precisely wanted by central banks all over the world. On the con side, you of course have very low fund fees, but there are still fees compared to regular stocks to a regular stock that does not have any fund fees, of course. Perhaps I should briefly mention here that we are talking about costs of 0.1 to 0.5 5% per year. Always having in mind that the long-term global average stock market return sits at around 7%, before inflation that is. To make these costs tangible, with $10,000 in an ETF, 0.25% costs would be $25 per year. So it's not much and often negligible compared to the broker's trading fees, but it's also not nothing. The following two cons are connected to the advantage of the easy diversification on the left. Diversification can be a blessing, but it can also be a little bit of a curse, because while it guarantees you the market return, at least of the market you cover with your ETF, you will logically never beat the market you invest in. However, this is not a real con to me. That's why it's colored in orange, by the way, since it's just a mathematical characteristic of a passive index fund. No cherry picking refers to the fact that the ETF will simply invest into all companies of the index it tracks. Also in those companies you might consider trash or unethical, for example. At the risk of finally confusing you completely, I should perhaps mention at this point that not all ETFs are simple passive index funds. Strictly speaking, the term ETF does not promise that either. The fact is that the absolute majority of ETFs passively tracks indices, but there are also actively managed exchange-traded funds, such as the now quite famous, at least in the USA, ARK Innovation ETF. Under fund type, you can see active equity ETF, and as I told you before, active funds need someone to be active, at least a fund manager and a research team. Of course, this is more expensive to operate than to let a computer track an index. And this is precisely what you can see down here or down there when you look at the expense ratio. 0.75% might not seem all too much, especially if you are familiar with the running costs of mutual funds. However, 0.75% is 3 times as expensive as the 0.25 passive ETF I calculated with earlier. In absolute numbers, that would mean you would have to pay 75 USD per year in fees on 10 grand invested instead of 25 USD. Now, the ARK Innovation ETF is maybe a bad example here, at least for the story I want to tell you, because its performance was phenomenal over the past 5 years. In any case, it was not a bad idea to pay the additional costs for the actively managed ETF. Nevertheless, the great majority of mutual funds and active ETFs have not been able to outperform the markets long term, or actually their market long term. So you had to pay more for a product that performed worse than the market. And also with the ARK ETF, nobody knows how it's going to continue, because remember the general rule, past returns are no indicator of future performance. Okay, enough of the preface. It is important to me to give you at least a thin foundation before I get into the practical part. Step 1. Choose your strategy. Do you want to invest into a specific region or sector? For example, do you want an ETF that solely covers the US, or maybe an ETF that strictly focuses on healthcare companies? If you are a beginner and you haven't done so already, I would highly suggest you start off with a globally and across all sectors diversified ETF. Also, later on, this kind of ETF can make a great, reliable and solid foundation of your portfolio. And if you think about it, this is also a very rational approach. Especially at the beginning, you don't know much about markets and it's very hard to assess the risks at play, if you are honest. Therefore, in my opinion, it makes sense to just put a tiny bit of your money into many, many very different companies across the globe. And then you just watch how it goes for a couple of months at least. How can you handle the volatility? Do you check your portfolio daily? Do you get anxious when you see the numbers turn red? Those are all questions you should answer to yourself during these months. And then when you did this and have further educated yourself, then you could maybe start thinking about doubling down on specific regions, sectors, or even single companies. It's also fine, of course, if you don't want to proceed with the second step. You might even be better off with the additional benefit of not making investing your hobby. If this makes sense to you, then you might still be waiting for an actual ETF suggestion. Please always bear in mind that I'm just a guy from YouTube, and therefore everything I say here should not be considered advice. I am not a financial advisor, even though it would be an interesting question if you even should trust a financial advisor from your local bank. I'm guessing that some of you ended up here in this video because that's exactly what you did for years, missing out on solid market returns whilst paying high fees. Okay, disclaimer done. As I explained before, most passive ETFs reproduce an index. The two best known worldwide across all equity sectors diversified indices are the MSCI World Index by MSCI and the FTSE All World Index by the FTSE Group. While the classic MSCI World, which is calculated since 1969, covers all 23 developed markets / countries, the FTSE All World Index covers the developed markets as well as the emerging markets. This means that the MSCI World covers approximately 85% of the worldwide investable market. The even broader FTSE All World covers 90 to 95%. With this already very large diversification, broader does not necessarily have to mean better. In my experience, those two world indices are simply the best known, and that's why I am presenting them. In fact, there are multiple versions of both of them. There is the MSCI All World Index as well as a FTSE Developed World Index. Now that I presented two indices, I will show you two ETFs that actually recreate these indices. iShares by BlackRock is most likely the largest ETF provider, and they recreate a lot of the MSCI indices and also this classic MSCI World Index here. Vanguard, another huge American ETF provider, is known for recreating FTSE indices. While Vanguard is a prestigious institution in the US, iShares is much more present and prominent in Europe. For the sake of simplicity, I will only use the MSCI World as my example for the next steps, and also because there is a greater assortment of ETF providers for MSCI indices. Okay, proceeding to step 2. You have to either choose the distributing or accumulating ETF variant. Here you can see many different ETF providers like iShares that we already know, Xtrackers, Luxor, HSBC, and many more. They are available in Germany, for example, and they all offer an ETF that tracks the MSCI World Index. Under distribution policy, you recognize the distributing and accumulating variants. As you most likely already know, many companies pay out dividends to their shareholders. By investing in an MSCI World ETF, those companies are its top holdings, meaning that for every dollar or euro you invest into one of these ETFs, 4.13 cents get invested into Apple, 3.12 cents are used to buy Microsoft, and so on. Johnson & Johnson, for example, pays out a dividend every quarter. Since the ETF basically bought a very small fraction of Johnson & Johnson for you, the ETF provider then receives this dividend and also all other dividends from companies in the ETF. The question now is, what should the ETF provider do with these dividends they received for you? And now you will understand the ETF provider can now either distribute these dividends to you in cash, or the dividends directly get reinvested into the fund. It's completely up to you. Do you want to receive small cash payments about 4 times a year, or would you reinvest this money anyway and therefore choose the accumulating ETFs, which saves you the work? You have to make this decision. To help you a little bit, to make a good decision, I want to say that the accumulating variants are the shoot and forget solution if you're searching for this. With the distributing versions, you very likely log in to your brokerage account a few times a year to invest or simply consume the payouts. However, this can also have a motivating effect. If you invest more and more, you will see the tangible result of receiving larger and larger payouts. With accumulating ETFs, you can only look at numbers on your screen. The most rational reason to start with distributing variants of ETFs often are tax reasons. In Germany, for example, we have an 801 euro capital gains tax exempt amount. You let a little bit of this tax exemption go to waste if you go for the accumulating variants. But just like with all things tax, this can be very different in your country, so please check that. And by the way, to get these lists of ETFs, I can recommend the website justetf.com, where I drew this data from. Another great website for finding the fitting ETF for your strategy and preferences is Extra ETF that I'm using here. So you now know what distributing and accumulating is all about. For step 3, I suggest to look at the cost or fund fees. They are often just described as TER, what stands for total expense ratio. Look at the cost, TER. The TER, here outlined in red, is a percentage that indicates the annual running costs of an ETF. For example, if you invest 1000 USD into the first ETF that has a TER of 0.2%, then you would pay $2 in fees for 1 year. However, you will never be billed for this amount directly. This is actually what I didn't understand when I started. So instead of billing you this amount directly, the ETF provider deducts these costs from the fund assets on a daily basis, meaning your returns will be slightly reduced by these costs. Obviously, you should find an ETF with low costs, or TER as we know now. Nevertheless, you should not just go for the ETF with the lowest TER. There are a few small points more to consider. And that brings us to step 4, where I group these points together: replication method, fund size, and savings plan ability. Number 1, replication method. As I explained before, most ETFs are replicating an index. So they buy small parts of all companies that the index is composed of. This process is called replication of the underlying index. 3 basic methods are available for an ETF provider to replicate an index, and we can see examples of all 3 methods on this list of, again, MSCI World ETFs. The classic and most intuitive method is to make a full physical replication, meaning the ETF would buy shares of truly all companies in the index. The UBS ETF at the bottom does exactly that. However, this full physical replication might not always be possible for liquidity reasons, for example, or where it's not necessary, or where it's not most cost effective. So the second method an ETF can choose is physical sampling, where only the most important or liquid securities are purchased because they have the greatest influence on the performance. And this ETF selection right here, this ETF selection right here, this method is described as optimized sampling. Thirdly, an ETF provider can choose to not truly invest into the underlying companies, but only to map them by using derivatives and swaps. As you might have guessed, this is what makes this method here called swap-based unfunded somewhat controversial. On the one hand, these ETFs are often cheap in terms of TER because they internally have cost and tax benefits for the ETF provider. On the other hand, these synthetic funds point to several risks, like the counterparty risk that I already touched on in the broker overview 2021, for example. And that is why I personally would not start to invest into ETFs that use this synthetic swap-based replication method. To me, it's simply not worth the increased risk only to pay €5 less in fees per year. Okay, then moving on to the topic of fund size, bigger is better is a good rule of thumb when comparing similar ETFs as we do here in terms of their fund size. Larger ETFs can exploit economies of scale to lower their costs and are less liable to liquidation with unfortunate consequences for your returns. And as a minimum fund size, generally for ETFs, I would say about 100 million should be the minimum. Doesn't really matter if it's euros or US dollars. But because we are looking at very common and not niche ETFs, this is not an issue here. But still, generally, bigger is better when it comes to fund size of ETFs. And lastly, we kind of end up where we started, at the link between your broker and the ETF, because it does not make sense to find the perfect ETF with the lowest TR to only then realize your broker doesn't even offer this ETF at all, or does not offer a savings plan for it, or this savings plan is not free, what often makes your careful TER research obsolete. So this is why I wanted to remind you at the end to view your investment decisions a little bit holistically. Even though the fees of a broker should never prevent you from investing into something long-term, then rather change the broker, but you simply don't want to do this every couple of months. As a take-home message, I present you all 4 steps again. The first step, to choose your strategy, is by far the most crucial one. If the region or sector is a bad choice, then steps 2, 3, and 4 are not going to save you. Step 2 to 4 should be considered the cherry on the cake. And with that said, thank you for watching. I honestly hope this video brought you added value and that you now feel a little bit safer about starting your ETF investing adventures. You can help me to grow this community further by subscribing to my channel, but also if you don't, just remember, just be lekker. Bye bye.